Okay, great. Well, to be respectful of everyone's time, we're gonna get going here. I'm Eric Ludwig. First of all, welcome. And I just wanted to say that I hope you've all had a great summer. It's kind of crazy that it's officially fall now. And if you're like me, you might be celebrating that your kids are back in school. So first of all, thanks for joining us today for the American College webinar titled What Retirement Planners Need to Know and How to Communicate It. And I think today's discussion is going to give you some great and practical thoughts on many of the things that are going on in the world right now, but also more importantly, maybe as to how to talk to your clients about some of the questions that they might be asking you right now. If I'm not mistaken, there's some kind of election going on this fall. We keep hearing things about interest rates have been in the news, and there's of course some law changes that are always up for grabs. And honestly, it is hard to keep track of it. So we wanted to make sure that we could provide you, in this case, about 50 to 60 minutes worth of updates. And then also, like I said, some talking points that we hope that you'll find useful. To begin, I'm Eric Ludwig. I'm director of the Center for Retirement Income and also the director of the Retirement Income Certified Professional designation, otherwise known as the RICP, joined by my colleague, Steve Parrish. He's a professor of practice and also a scholar in residence at the Carrie M. McGuire Center for Ethics and Financial Services. And we also have our very special guest, Rob Williams. He's a RICP, by the way, also a CFP, a CPWA, and his job is the Managing Director of Financial Planning, Retirement Income and Wealth Management with the Schwab Center for Financial Research. I also just want to say hello and thanks to our media partner, Investment News. All right, and with that, we all should be on camera here. So welcome, Rob. Welcome, Steve.
Good to be here. Thanks, Eric.
All right. Well, so to get started, Steve, I know especially with your JD background, I thought this would be an interesting place to start. As I mentioned, there's a lot of stuff going on in the news, and I wanted to ask you to begin with, if you could give kind of an overview of the environment that retirement planners are operating in right now.
Yeah, and hello, everybody. So really, if you think about it, I mean, we're approaching the fourth quarter, and there's a lot going on, economic, legislative, regulatory. So I thought I'd talk about the legislative and regulatory up front, and then the majority from there will be talking to these two experts and some of the more economic stuff. But what I want to do is talk about this, what's going on in legislation, because as we approach this, and we're saying how we're going to work with our clients in the fourth quarter and beyond, a few things going on. First of all, the big one obviously is the sunsetting of the Tax Cuts and Jobs Act. And there's this, you referenced an election. I believe you're correct on that. There is one coming up based on what I've been seeing on TV. And the deal is, something is going to have to happen. There is no status quo, because what happens is at the end of next year, we sunset back to pre-TCJA. So if let's just take the crystal ball. If the Republicans were to just have a huge win, that doesn't necessarily mean that they're just going to vote to extend the Tax Cuts and Jobs Act, because it turned out to be that was very expensive. They thought they would make some money on this global taxation regime they had, and it didn't really turn out to be true. So the deficit hawks may not be all that big on just extending the Tax Cuts and Jobs Act. Similarly, if the Democrats had a really big November and they won, they're not just going to let this expire and say, good, we can go back to pre-Trump years, because that would hurt middle class because of some of those tax brackets. So they've already made it clear there's some things they want to do, especially some of these business tax things. So the effect to the advisor is now you really have to look and say, you're going to be dealing with a new tax law. I don't know exactly when, but you will be dealing with the new tax law one way or another. And especially for your high net worth and ultra high net worth clients, you got to prepare for sunset now because of what's going on with the state taxes. We really can't wait. And my tip to you, if you haven't thought about this, is you really got to get going now in this last quarter or the beginning of next year, because you're going to need the help of estate attorneys, and you're going to be doing some appraisals for the high net worth individuals. And the trouble is they are already buried. They are really going to get buried. And by the way, the attorneys who would typically work on this are already buried because they're working on the the CTA. So, I mean, their hands are going to be full. So you really need to get this going now. Two other quick things on this. Social Security, you hear these politicians that say, oh, I'm not going to touch Social Security. Saying that means that they're okay with a 25% haircut because that's what's going to happen when the trust fund runs out. So that's another one where Congress is going to have to do something or other. And then, of course, we got Secure 2.0, where we're still trying to figure it out. At least we got some regulations to work with. The big one, that was kind of the legislative. On the regulatory side, clearly the big issue is this whole Loper-Bright rule that basically vacated the Chevron deference. That's a lot of words.
Just to clarify, Steve, before you go further, you said 25% haircut. Can you just, if someone didn't know, what are you talking about there in terms of Social Security?
Yeah. Well, in other words, they come out with a trust report every year from the Social Security Administration, and they basically said that all things being equal, which never are, in 10 years, the trust fund will have exhausted itself. And the way it works is that Congress can't just say, we'll just pay out of the general fund. They would actually have to proactively pass a law to make up the difference. If they don't make up the difference, the current projections around 23%, and that's across the board. So everybody would get that haircut. So all I'm saying is Congress, much like in the early 80s, has to do something, or their biggest constituency is going to say, oops, we just took a haircut, and that's not going to go over well. And on that regulatory one, give me a minute to just describe this, because you don't hear this much in these kind of sessions, and then we'll get into some of the economic issues. But this whole Chevron deference and all that, let me kind of throw in what's going on here. When I was teaching law school a few years ago, a lot of us saw this coming, and I actually had my law students write a paper about the effect of Chevron if Chevron got thrown out. Well, it did. The basic idea is this. Look, Congress passes these laws that are too general, too ambiguous, and the Chevron deference basically said, look, if somebody's not happy with a regulation and it goes into just a regular judicial court, the courts have to defer to the federal agencies on ambiguous questions. In other words, they have to say, well, you guys are the experts at your agency we're dealing with, and so they have to defer. Well, that's a very high bar. The only time, well, I shouldn't say only, but the biggest one I've seen where they got over that bar was, do you remember back in 2018 when the Fifth Circuit threw out the DOL rule? Basically, they said that is so far from being within the purview of the law that we're going to throw it out. Well, so what's going on is now the Supreme Court said, no, that doesn't apply anymore. That's the Loper case. And you don't have to defer. So whatever your politics are, this is the concern, just from a practical effect to you as advisors, is first of all, we will definitely, I was going to say we are seeing forum shopping. So many of you are familiar with the current DOL rule, and that's tied up in two jurisdictions in Texas. They basically shopped for a conservative judge to essentially throw it out, and then it's going to get appealed and all that. And what's going to happen is important regulatory issues will be tied up in courts for years. And again, I don't want to get into the politics of that, but it will make it easier probably for you at the regulatory standpoint that you may not have to do as many things as it looked like you might have to do. But I worry about financial fraud. The simple fact is people who don't like what they see in a regulation now can tie it up in court for years. So what I would expect as you think about how you're going to do your practice management, expect a lot of fits and starts from your broker-dealer, your RIA, your home office, because financial regulations are going to be all over the place until the U.S. comes up with some kind of workable solution in all this chaos. I mean, we have a tax court for tax stuff. We have a bankruptcy court, but we don't have any other specialty courts. So you're going to have judges who might be good at parking tickets and bankruptcy, trying to sort through a DOL rule. So that's kind of my intro. Let's get to the economics. Eric, you and Rob. So we just had a 50 basis point drop in the Fed rate. And yes, we've confirmed there is an election coming up. Erica, What's your crystal ball tell you about the economic environment for retirement planning? And I talked about regulations and taxes and all, but what's that mean for planning, retirement planning for your clients?
Sure. Well, oddly enough, I actually do have a crystal ball. I got it from a wholesaler several years ago that I keep on my desk. So the unfortunate thing is every time I look at it, it's just my own face upside down. So it doesn't really tell me anything. But I'll try to give some practical thoughts for planners on here. The one thing is the interest rate curve. Like you asked about this in the context of retirement planning, right? I know Rob's going to definitely have some opinions on this as well. So the one thing is from an interest rate sensitivity is investors are still being paid more on the shorter end of the duration spectrum, right? So if you think about the yield curve, 3-month treasuries, last time I looked, we're still paying the same, if not maybe even a little bit more than what you're getting on a 30-year treasury. So think about that. That's kind of insane in a way, right? The 3-month is paying the same yield as a 30-year. So it hasn't really paid to go long in duration. And the way that I keep thinking about this is the curve gives us like a snapshot of just current time. Like, what does the curve look like? But I think you really have to look at this in more of like a three-dimensional kind of method. You have to think about the curve, the shape of the curve, whether it's sort of inverted or not, but then also how we think yields are going to move up or down across that full spectrum. So like, for example, if you think about the current yield curve, it's inverted, right? So like shorter term yields are paying more than longer term, but that's also been true from like a year ago, right? So the shape is really the same, but they've over all of those durations, the interest rates have come down. So that's like the first part is how is that moving? And then across the different spectrum, how are those moving? So just some kind of practical thoughts on that. If it's a shorter term instrument, as you mentioned, we've seen rates come down. Again, if you think about what the Fed can control, it's really more in the short term spectrum, right? Like it's not going to automatically go out to like all of a sudden mortgage rates drop by 50 basis points. They're only controlling things on the shorter term of the spectrum. And so I think we're going to continue to see downward pressure there. And I know, Rob, I just saw an article that you had posted to on LinkedIn and you can talk about more from an investment or a reinvestment risk position. The other part is that longer dated yields really haven't moved much, right? So that's kind of the other thing to think about. The reason I bring that part up too is sometimes what we see advisors do is go yield chasing. So it's all of a sudden the junk bonds or the closed-end funds with these crazy distribution yields or whatever, pick your flavor of high yield, whatever, all of a sudden looks appealing. And I just think people need to be cautious about that. Someone showed me this simple math problem, and it's going to be oversimplified, but the way that they had talked about this is if you look at a current yield of, say, a high yield bond, that just say it's 6%, just to make math easy. But then you look further at the credit quality of that and look at what the default rate is, and just say it's 80%, again, just to make it easy. If 80% of those bonds that were paying 6%, or rather 20% of them fail, you really end up with a 4.8% yield. So you got to kind of think about the post-default or default adjusted rate that you're actually going to end up with. I've talked too long. I want to hear Rob, because you've written and talked about this as well. I'm curious in terms of risk and interest rates. What are you seeing at Schwab?
Yeah, thanks. Gosh, there's so many things that come to mind as both of you are talking, so I cover a lot of them, I hope. But first thing that comes to mind to me is just the combination of sort of the technical aspects, both of the economy and the legislative things that Steve is talking about, taxes, and the emotional side of it. And maybe we can come back to that a little bit. But on the economic side, I mean, the yield curve, I think that was a great description, Eric. That's always such a hard thing to describe in terms of what it means and says and what you do about it. But it's really, it's anticipating what the Fed, they already cut 50 basis points, as you said, and that is going to lower the front end of the curve. So for the last year or two, they raised rates really quickly, unprecedented, really. And that's made returns on cash very attractive. Cash investments, money market funds, et cetera. But those are going to fall now. And the yield curve, as you did say, is inverted, and longer term, intermediate term rates have fallen some. That's kind of a voting mechanism of the yield curve on the state of the economy. And that's what the Fed's watching, as they've shifted from inflation watch to employment watch. And the 50 basis point move, it makes it pretty clear that they've said inflation is under control at this point. It's at the 3% or so level. That's still not comfortable emotionally. We can come back to that, and a lot of expenses for retirees are permanently higher. And that's a major planning issue I've written and talked about, which is economists and the Fed will say, well, the pace of inflation is slowing. Well, the pain is still felt, and planning for it is still important. So that's a little bit on the, how they've shifted. They've shifted to looking at the economy. Now, I tend to also think of the yield curve. This is, I don't know what the stat is exactly, but 80% of the investment grade market or so is less than 10-year maturities. So we're talking, when you're talking about bond portfolios, 30-year treasuries are kind of for diversification, for the most part. It's where you position kind of the bond portfolio in that intermediate term. So, we've been encouraging extend duration. I like to think of it, if you have bond, mutual funds, et cetera, you can extend those a bit, because the cash reinvestment risk is going to be the issue. Cash rates will fall. We see a lot of investors pretty heavily in cash, but, repositioning, out on the yield curve a little bit is probably the best path, from a planning perspective. I also, maybe we can come back to this because I don't want to talk too much, but asset liability matching, I think, is a really powerful concept in retirement income planning, using individual high quality bonds, CDs, to target maturities along the yield curve to say, this is when I need money. Because as you said, investment income and credit risk has risks, downside risks, and it may be tempting, but in a downturn, et cetera, the correlation of the higher credit, risk instruments tends to go up to equities, so that diversification tends to evaporate. So that was a lot of topics, Eric, but me, I'll maybe come back to a couple of them, but I hope that provided some insight.
Well, let me ask it in a practical standpoint. I guess I'll start with you, Rob, but we've done a lot of these webinars, and back when interest rates were lower, we had Dr. Wade Pfau say the 4% rule ought to be the 3% rule. And then you remember when Morningstar gave it an exact number, like 3.16 or something. And now we see Barron's and Dr. Blanchette talking about 5%. And by the way, I know we all agree that the 4% rule is kind of garbage from the beginning in some ways anyway, but you're at Schwab and you've got your advisor saying, my client wants to know what a safe withdrawal rate is to take. How do you answer that in the current environment and with what we've just talked about with where rates are going?
Yeah, now you're going to get me fired up, Steve, and I'll start talking faster. Whatever your view is on the 4% rule, I've written about this. All the folks you've mentioned have written about it, colleagues of ours. And I think it was a fine idea. And I think from the beginning, in terms of the 4% rule, in terms of what could be sustainable historically, and even the worst environment, assuming you follow it correctly, which is a big if, meaning it's only relevant in the first year of a 30-year retirement, that percent. And after that, you're really increasing the amount you withdraw without thinking, without any change for 30 years, with whatever the inflation rate is. And if you look backwards. Now, I think, my opinion, it's a heuristic, it's a number, we anchor on it, we remember it. It's coincidentally pretty close to yields at times. So we think, well, I'm an investment manager, so I'll get a 4% yield. In our view, that is not what it means. That can be the simple path. And I'm not too much in the debate or in the camp of this, is it high or is it low? I just think it's not the right metric. We should be flexible. There's a lot of writing, and we've written about this, whether it's the guardrails approach that Guyton has written about. I like that. We tend to focus on using planning tools where there's a probability of success, which we could debate certainly. But if you get out of a range, you can empower your clients as an advisor to help them decide. And if the market's down somewhat or they have a big withdrawal, redo the plan. The great advantage of financial planning now is that it's not just a one-time thing, it's ongoing. We have the technology, whatever tools you use. So our view is 4% rule, memorable, but can we move on? Let's move on to more personalized, sustainable withdrawal rates based on conditions as they change. And that probably empowers you as an advisor as well, as to include your client in the decisions. And you can have a baseline of essential expenses you wouldn't change, use annuities, et cetera. But when it comes to withdrawing from the portfolio, which is what the 4% rule is about, partner with them, adjust, and that helps money last. So Steve, that's my view and our view.
And I'm going to ask the same question to you, Eric, because in RICP we teach it because you got to have something, and like you said, it's a heuristic, and that it's a good place to start. But I know that you also have clients. How do you deal with it, especially in this kind of somewhat chaotic environment where rates were super low, went up, now are coming down? How do you advise them on that? What measure do you use?
Mm-hmm. Yeah, I always it's interesting to me because, as advisors, we're familiar with the 4% rule. But what's most interesting to me is that you do have a lot of retirees or pre-retirees that are familiar. They're like, oh yeah, 4% rule. And that's what they call it, and that's what they refer to it as, is the 4% rule. I always like to do a quick history lesson just to remind people what it is, kind of what the work was, where that actually came from. And to remember that there was a guy named Bill Bengen that in 1994, he wrote a paper, right? And that's interesting to me in a way, because it's like a lot of the stuff that we write, it's like other academics reading it. But the thing that I like to focus on is to remind people that what Bengen did is he used historical returns of the US market, at least originally, of indices, right? So it was like the S&P 500 and treasuries, if I'm not mistaken. And it was like a 50-50 allocation to stocks and bonds. And he used the returns in the sequence that they actually occurred, right? And so we've gotten better, like Rob was mentioning, things like these software tools incorporate things like Monte Carlo, so you can start simulating, different sequences of returns to say well, what if this exact same market sequence had the same way, but it went backwards? And then you can kind of keep reshuffling through these different ways that the returns happen. So I just like to kind of remind people that 4% came from this idea of what Bengen called safe max, which was really just like Rob said, it was the withdrawal rate that someone could start with in the first year and then increase it with inflation to then last 30 years. There's kind of cool research on, is it too low or is it too high? And in the too high camp, one of the interesting things is that that first study used just US equity returns. It turns out that if you look at different countries and use their local stock market, the 4% actually only worked out in US and Canada. Right. So, and I think if you use Denmark and gave them a 10% success rate, it worked in Denmark, something like that. So that's one reason why it might be too high. Also, like Rob was saying, what if someone retires in a low yield environment or a high equity valuation market? That makes a big difference. And the other thing that I like to remind people is that the last 30-year chunk of time that we had started in 1994. So for the investor that retired in, say, a 2008 and had their first 10 years, or from 2000 to 2010 had a flat equity return, we don't know what the full 30-year effect of that is, right? So there's kind of this going back and forth and making sure. But to Rob's point, I think the big thing of why the 4% can be too low is once you start actually matching withdrawal rates up with actual spending patterns and being more flexible with how people are actually spending their money, that's where I start talking to people about like, yeah, actually your initial withdrawal rate can be higher than 4% as long as you realize, hey, if the market has a poor year, then we're going to actually do something about that. And so that's the kind of conversation of how I talk to clients about that.
Maybe I could just add to it, because I'm so deep in thinking about this question too from an academic point of view. And when I went to business school, I discovered Monte Carlo, and I thought this is the coolest, most fun thing I've ever seen. I'm going to do my whole life in Monte Carlo. So, the 4% rule, sorry, this is not meant to any offense. To anyone that works on it, I've done it too. You run the Monte Carlo, you do all the simulations, et cetera. I do think that, Eric, I'd ask you do clients know they hear that, but it's only relevant in that first year? I always wonder, like, well, if you're 70 or you're 80, it's very different. But it is so memorable. So I do think we can do a lot better. And the way you described it is quite right in terms of the history and William Bengen. And we could ask him. I think he might even admit at this point that perhaps we could move on. And I think he has. That and getting it also away from income. We talked about interest rates. One big phrase, you guys talked about talking points, broaden your definition of income. I found it so fascinating working in both the asset management space at times and the planning space, how different those worlds can be, where you think about investment income. Many of you are in that asset management space, but retirement income planning really, to me, is about sustainable retirement distribution management for the portfolio, and then using insurance, annuities, et cetera. That's a big, complex puzzle. So getting too fixated on where interest rates are, et cetera. You could argue interest rates were low and that drove returns in the stock market. That's what they were aiming to do to keep the economy growing. So I just suggest maybe that phrase, broaden your definition of income, then have a personalized, annually updated distribution plan. Feels like a modern approach to sustainable, portfolio management.
I really like that. I think to the extent that, especially in today's world where advisors aren't transactional and we're, talking to clients that, hey, this is a long-term relationship that we're going to have together. I think to me that kind of sells a point is like, well, what is my withdrawal rate going to be from year to year? I don't know. That's the whole point is we're going to work together on this, right? And adjust as your life unfolds.
I think that's very true. And if you want to pivot from being an alpha focused advisor only to more of the gamma or other things where it's the value out of that personal relationship, which I believe it is, tax efficiency, knowing the laws that Steve talked about and regulations, that's a pivot that I think the entire industry is making. In the retirement income space, it's most visible. You're there to help be a counsel and a coach to help them manage their resources effectively, and a 4% rule is nice, but we can do better. So,
what about this, Rob? I got kind of a similar or related question in terms of thinking about risk. I know, like you mentioned that the way a retirement planner might think about risk might be different than like an asset manager might think about risk. And for a lot of the people on the webinar, I'm thinking that we think about this more from the view of how does this relate to a client and their risk. So give me some thought. I know when we were prepping for this, you had some really cool thoughts on this. So I'll just let you run with it. When we think about planning for risk and retirement, how should people be thinking about this or talking about it with their clients?
Yeah, this is another where there's a traditional way, maybe that's not the right word, but we tend to talk about risk, from a CFA, modern portfolio theory approach. That's how many of us have been trained. And especially if you're an advisor or an asset manager, we think about volatility. I think the move is definitely the evolution, is more toward defining risk in the context of the client themselves. Are they going to achieve their goals if they're saving or pay for a wedding or go on a trip? Or are they going to be able to have their money last? Are they going to be able to leave a legacy? Are they going to get into a healthcare event and know that their wishes will be followed, have confidence that all those things will be achieved. That is a different, harder to measure of risk, but is bigger, broader, and perhaps more important. And making sure your money lasts, that's a big risk. Certainly, talking about insurance and annuities, that comes up a lot. To the portfolio, though, a big topic I've been talking about and really like and seems to resonate when I talk to our clients at events and things, and our advisors even. It's a bit of an epiphany. It's a surprise to them, is risk capacity. First, when do you need the money is more important when you get to or close to retirement than risk tolerance. In our investment policy questionnaires at Schwab, when you need the money trumps anything else with risk tolerance. So if you say I need money in 5 years, or for a kid's education, et cetera, probably should not be invested heavily in the stock market. You need what I would describe as liquidity in a pure sense, which is not just I can sell it, but I can sell it at a price that is not going to be highly dependent on the whims of the market or the economy at a particular time. You have a crystal ball, Eric? I don't, but if I did, it would just show my reflection too. And and a lot of economists, we can predict the weather, but the weather will change. The key is to be ready for it, whatever happens. And that's where we talk about bucketing and maybe having 2 to 4 years of a short-term bond ladder or even short-term bond fund in place for withdrawals that are needed for the next 2 to 4 years in the portfolio, whether you bucket or not, it's up to you. But having those stable things that don't move around as much is helping manage to risk capacity, the timing of when money is needed. Then we find that investors feel a lot more confident that they can take the risks that you have talked with them about for longer term money, for legacy planning, et cetera. And that's a bit of a pivot from just the pure pie chart diversification thinking. But the main talking point there is let's focus on risk capacity. When do you need the money first? And risk tolerance may become second. Does that make sense?
I like that a lot. Yeah, because I think, and a lot of people when you talk to advisors, they complain about the risk tolerance questionnaire. We give the 10 questions or the 20 questions or whatever, and then they still find that a market downturn happens and the portfolio that was built off of add these 20 things up and you get the score and you do this, right? That all of a sudden it's like, well, the market was down 10% and people just want to jump ship. And it's like, well, wait a minute, this supposed, questionnaire that was supposed to help me build the portfolio, all of a sudden people aren't adhering to that. So I think to your point, I mean, I guess how would you think about that then? I mean, is it the survey's problem? Is it how advisors are then communicating what the results are? Or?
It's a great question. I mean, it's a mental accounting thing as much to me. The questionnaires and things, you all have what you have and how they're structured, but also just the conversation you have. I have a picture, I wish we could share it, where it's the risk tolerance is like you holding your stomach and I might feel sick, and risk capacity is like, what money do I need soon? And, I think bucketing is a really good strategy to help with that mental accounting. We're fortunate to have different account types too. However you do it in your own practice, we found that sometimes it's hard to look at a pie chart and then suddenly say, do I need multiple bucketed accounts? This is the art of the conversation, I think, which is to say, this is what I think you want to walk away with being able to say. If we have a big market downturn, we're going to be fine for the next 2 to 4 years because we have some more stable things. They're not going to beat the stock market. That's not our plan. But they're there in case of a downturn because you only get to retire once. We can't control the markets, but I want to make sure we've got that cushion in place so then we can take the risk we need with the rest of your portfolio based on the questionnaire, et cetera. However you say it, that's the message. I don't know if you have any thoughts on how do you share that, but we've just found that really makes people say, hey, my mother said this. She's like, oh, the market's up, down, but you helped me with this bucketing idea and I have the money. She doesn't bother me about her mutual fund choices as much anymore. So I take that as a victory.
I love that. I mean, because even in like Wade Pfau's book, I sort of keep a copy by my desk, the retirement
Great
planning
book.
guidebook.
Yes, great. Thank you. thank you, Wade, for your and others you've mentioned for all their work in this field. It's really taken us a long way. But sorry, Eric, go ahead.
Yeah, I mean, all I was going to say is he has some great comments in there about how if you looked at it purely from like an economist standpoint, like you brought up the Monte Carlo stuff. If you look at like bucketing from a modeling perspective, no, it's probably not going to be as efficient. But to your point, Rob, when you factor in behavior and the willingness that people are to stick with their actual portfolio when stuff hits the fan and actually gets them through, that's where the behavioral benefits of these come about. So it's not just, hey, I ran this Monte Carlo and this showed up as, better or not. How did people actually behave, in the real world? And I think that's where some of these other strategies can be beneficial. I
Well,
kind of
I
wanted
mean, that's the definition of risk right there, Eric, is how will your client behave when things get rough? So that's a nice full circle there. It helps manage that risk of doing something that you don't want to do when the stress is on. And we know it. We know it happens. That's how markets behave.
Steve, this might be a good point for you too. I know one way to deal with some of this is to include income annuities into the equation. And I know they've been on a bit of a hot streak in the last few years with interest rates changing like we've been talking about. I mean, is this something that you think is going to go away, or what? How do you think about that?
Right. That's a fascinating question because clearly the curve went up when interest rates went up. I mean, almost dollar for dollar annuity sales went up. Personally, I don't think they're going to go down as quick for two reasons. One is people finally started realizing that they have defined contribution, not defined benefit plans, and so they need some kind of income source. And so what I'm seeing is, and I mean, just look in the press, annuities aren't the evil thing they used to be before. And so the whole I hate annuities, and everybody knows what I'm referring to, school of thought is not as popular as it used to be. So I guess I'm saying is in the popular mind, annuities have gotten legitimacy and credibility. The second thing that I don't think people are thinking about, but is certainly going to be a big deal, is what the Secure Act did. The Secure Act came in and basically said, look, we recognize people just can't have a number. They need some kind of a guaranteed income source. And so we're going to make it easier for employers to offer annuities as an asset in the 401k plan. And it was really slow to start. I was just surprised some of the big companies that you would think that would come out with some pretty interesting tools didn't. But you know what? Now they are. Now, maybe that's not good news for people on the webcast right now, because that means that people may be buying their annuities at work rather than rolling over their 401k and buying an annuity from you. But I'm just saying that's making annuities a bigger deal. The other thing I wanted to mention is I just saw this research from, I want to get it right, Nationwide. It was called Protected Retirement Survey, and just came out last month. And one of the things they said is employees are also shifting how they view retirement. And so instead of seeing it as a lump sum, what's your number? Remember the what's your number commercials, 59% of them are thinking about retirement savings in terms of monthly income. So long way of saying, when you think about it, now that consumer is going, oh, I need an income, not just $1 million at retirement, they're starting to look at annuities. So the industry's gotten better at it, and they're now being offered through employers. So really, I don't think that the drop down in interest rate is going to affect it that much. That's where I'm at on it.
Yeah, that makes sense. What about you, Rob? I know Schwab obviously has a couple things to offer. Or is there
A few. I mean,
something
I'll just start with one of you all know it, the challenge are hopefully there's not two camps, the investment camp and the annuity camp. I see it. I think the combination is so powerful. Financial planning is comprehensive, wealth management is comprehensive, and the combination of insurance, investments, and cash, even is far more powerful than any of those alone. So I really hope that the tension. I think the annuity field is so challenging because what is an annuity really has become so complicated. Is it saving for retirement? Is it a VA? Is it have a living benefit? I think in a way that is a little unfortunate from an academic perspective and even mathematical. Single premium immediate annuities are so efficient and such a useful tool. With the cash repayments in the event of death, I think some of that I'm going to not get my money back. My family won't, maybe is no longer as much of an issue, but they're simple, and sometimes simple isn't the thing that we want to push. Other people can weigh in on that one, but I think they're very powerful. I hope they continue. Steve, your points about the regulatory pushes towards making them more accessible in retirement benefit plans is critical and helpful. I'll just add on one is sales. I think, Steve, you were getting at that, but we rewrote some and did some work on this, and the payout rates are higher. I think that's really important, is to think of annuities not as, we see a lot of investment people, it's about the investment, compared to bonds. It's not, it's a payout solution for life. And they're certainly higher. They tend, we found, to move with corporate interest rates, credit. So, those payout rates are still fairly attractive compared to where they were 8-9 years ago when all rates were so low. So I think they're very powerful. I think they're important. I tend to focus on them for the income, not as a savings and investing vehicle, and sort of using the simplest forms of investments with the simplest forms of guaranteed income and putting them together. I think the advice we give and how we get people there, we can continue to work on.
I really like that. That makes sense with how they're being positioned and getting away from sometimes just the name, because like you said, an annuity could refer to however many different types of products with different features. And if you boil it back down to like, what is the actual goal that you're trying to solve for? And then what are just different ways to provide that? And I think that's one of the big, I'm just going to mention Wade again, because I think one of the things that's been so interesting about his later work is that it did start to take into account the human and like, what are their preferences? And, what does that person actually prefer from a distribution perspective? Is it more that they prefer more freedom and options? Then that's one type of distribution plan that you can construct. Is it that they don't want to think about it, they just want guaranteed income, and that's just is what it is? Then that leads you down another path. So I think kind of aligning what the preferences are to with how these different products work, that helps people, again, to, like we were saying before, how you can stitch these two together so that people actually stick with the plan that you're putting together for them.
In the Q&A,
sorry, go ahead, Steve.
I was just going to say, in the Q&A box, someone made an interesting comment that Christine Benz from Morningstar said back in the day, annuities were considered skull and crossbones, but now, and very much to your point, Rob, they're being associated more on the income side, not the, mine's better than a CD rate type. And so they're being thought of much more as peace of mind. I think that's where the golden nugget is the peace of mind in retirement, not the my rate is a tax deferred and beat your CD rate way of looking at annuities. So go ahead.
I totally agree. I just want to add that we have this multi-decade, history of where it's sold as an investment vehicle or tax deferral. Then it's evolved, and I think and also high fees on some VAs, et cetera. And, I've had to explain to some folks at my firm that the SPIAs are expensive. Like, I don't really know what that means. Like, they don't have a fee. So just getting to that point of moving beyond to something else about what purely you're looking for. One other thought is complexity doesn't help, in my opinion. There's always this desire to cram lots of things together. And I understand it. I think it's probably, I want to provide an investment and an insurance. And this is just my personal opinion. I like sort of the purest versions of the things put together, but that takes planning, not a product. It's more putting the products together. And that's really where I think really good planners and advisors can help. Don't try to find one product, one solution. Find the best parts at the lowest possible cost to achieve the combination of objectives that you need to solve for. Does that make sense, Eric?
That does too. And I was thinking, Rob, I know we've talked in prior times too about the process being more important than the
Mhm.
actual like products, right? And so how have you talked about this with different people at Schwab in terms of process? And I'm just trying to think how I know like the different people on here are going to have their own sort of company's method, but some are independent like myself. Is there different ways that you think have been helpful for advisors to think about how would they build a process if they were open to ideas?
I think that's the biggest opportunity, and kudos to you guys with the RICP designation and putting that together. I think even that could move toward more process, because right now in the retirement income business, we're kind of in this, you've got kind of a set list of strategies you can pull from, and there are many paths, et cetera. And no fault of any of us saying the 4% rule, moving, buying some dividend paying stocks and moving on may be faster and simpler. So we're headed that way. We're headed toward more process. I think there's more room to go. I think the biggest, we have an approach at Schwab where we say start with a plan. That's going to lead to your asset allocation based on your risk capacity, not just your risk tolerance. When do you need the money? Then we're going to consider some distribution strategies. Do you want to use investment income first? Do you want to use a systematic withdrawal approach? Do you want to add a baseline of more guaranteed income over and above Social Security? What are your preferences? You got to that, Eric. I think that's really important. You can almost have risk tolerance questionnaires that start to include tolerance for retirement risks. How willing would you be to run out of money? And that will help with the suitability and not just cover your essentials with an annuity, maybe a simpler but not as personalized way. And then the last step is monitor. Continue to do this every year. It's a living, breathing rocket ship that continues upwards, and you sort of move between it. So start with a plan, then to your asset allocation, which could include annuities as part of the allocation, how to distribute the money, and then repeat. So monitor. That's a very simple process, but I agree with you. That's the missing link is how do you go about doing all of this?
I like that too, because I feel like not that we're selling people, but I mean, you can sell people on a process that, hey, this is how we work with clients. And that's actually a much, more realistic of what that relationship is going to be like going forward instead of, hey, yeah, oh yeah, you want to retire? Great. We have a couple of, we like to use low cost ETFs. Oh, okay, great. What does that mean for me? I just want to know that, where I'm coming from and that you're going to help me throughout my 30-year retirement or 40-year retirement. I think that's from a process perspective. And also when markets do get freaky, or even like now where there's, I think just a lot of things going on in the news, you can dial back to what the plan is, right? And it's like, and then it's just a matter of, hey, look, when we put the plan together last year, this time, you mentioned that, Jill is still going to college in about a year. Is that still a plan? Yep, great. And your wife said she was going to retire in about 2 years. Is that still the case? Yep. Okay, cool. And you can kind of walk through what the talking points were from last time. And if nothing's actually changed from that perspective, it feels like it can tie people back to like, oh yeah, that's why we're doing what we were doing.
I agree totally with that. And I think you can take it a step further because we often go back to the plan. But here's a thought for you. Also tie it back to the portfolio. We don't need to, I don't think we need to lead with alpha anymore or beating markets, et cetera. That is the tendency we know of many investors and clients, but I found that once you push, they really just want to feel comfortable and confident. And, they'll get to that with your coaching and help. But it can be because of what I heard about your plan. This is how we've positioned your bond ladder, or we have this much money in a short-term bond fund. That's meant to be more stable. And if you can tie that plan to the actual investments, and the investments in a generic way, the last step is product. Okay, we've decided this is what we're going to do. Now I'm going to pick the tile for the final tile for the bathroom. There's many ways to achieve this. That's how I think of product. I hope that resonates.
Yeah, I mean, I can tell you just firsthand experience yesterday. I had a client call And I thought it was the funniest thing because, like, to your point, we have RICP. Sometimes you go through the course and you're like, whoa, this is very complex, right? And it can be. But then I think about reality sometimes. So, like, the call that I got was it was the male, it was the husband of a coupled relationship. And he said, "Hey, Eric, I'm a the return of my IRA isn't as good as my wife's. Is there anything we can do about that?" And I said, "Well, hold on, let's just look at what's going on." And I was like, I won't say his name, but just say Joe. Joe, remember, you're taking distributions from your IRA.
Mm.
Sally is not. Oh yeah. Okay. Remember, we set your portfolio up to be generating income. Sally's not. Yep, that's right. And then he's like, well, there was some built up cash in there. And I was like, hey, what if we just reinvested this? Blah, 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 blah. And he's like, yep, sounds good. The funny thing to me was he didn't really care what I did because he had a tea time in 5 minutes. He's like, that's great. Just you're going to take care of it, right? Yep. Okay.
There you
So
go. Now you're the trusted advisor. I know we're want to probably
Really?
take some questions and getting close to the end, but one is we're emotional coaches, I believe. Now it's easy for me to say I talk to a lot of folks, but you guys work directly with clients. My main client's my mom, and at least she was happy, eventually. But it's to be able to come back and say, "You've got it. You've kind of got me, positioned for this." And that here's the last thought I'll kind of end with is legal issues, regulatory, elections, economy, markets. We are confronted with more noise than we've ever been confronted with as Americans or humans in history. And, finances are emotional. And to me, a good retirement distribution advisor in particular is about helping putting order to that noise and finding the signal, the process, the plan, the tie to investment allocation, et cetera, so that our clients can walk out of there and truly feel more confident that that noise is headed in the right direction for them. And that to me is the true calling of an advisor. And I'm proud to be part of it and really to be talking about it and to be part of this webcast. So, and thank all of you guys that are on the phone for doing it as a profession, because it really is important.
Good way to look at it. What I'm going to do is we do have a couple of questions, and one I'll go ahead and address, and if you've got something to add into it, please do too. The question's pretty straightforward because we're talking about the environment we're in right now. Is this a good time for Roth conversions? Well, first of all, as the person asking the question points out, that is so client-centric. It's all going to depend. But yeah, there's a lot of reasons to do it right now. Tax brackets aren't going to go down. I think we can establish that. Very well could go up. And so now is a good time to do your Roth conversion when the tax brackets are low. The other is we just got those regs for the Secure Act that basically said whether you thought it was right or not, if you've hit your retirement beginning date and you're taking RMDs, then and you die, when you pass that money on, that person has to take it in, pro rata over 10 years. The trouble is, if you die in your 80s, your kids are going to be in their 60s, and so they're going to be in their high tax brackets. It's sure a lot nicer to leave them a Roth than it's going to be to leave them a 401k or a traditional IRA. And one other point I would make, and then I'll throw a question at you, Eric, but it's not that hard to do things like Roth conversions. I think of Schwab. I happen to know that Schwab has a fairly easy way where you can just title it over. So if you said, I have this traditional IRA, I want it to be a Roth IRA, it's not that tricky. It's basically, it's just a titling thing, and you pay tax. That's not so fun, but otherwise you're good. So that just to comment on that, there is one that I thought was good, and I'll just ask you, Eric. Do you talk with clients about filling gaps in retirement? So we're kind of looking now at the younger person, such as time from retirement to collecting Social Security or traveling in early years. How do you look at that when you're talking to the 50 or let's say somebody in their 50s thinking about retirement?
Yeah, I mean that's a great question. It's super common, right? Because the type of clients that we're working with tend to have that flexibility of, right? I'm just thinking big picture, the average person, I'm just saying from survey data, the average person doesn't have a lot saved for retirement. So their default really is to turn on Social Security sort of as soon as that they retire because that is going to be their primary income source. I mean, my kind of default is that if clients can push Social Security claiming age out, that does allow for more flexibility. And then it maybe doesn't look that way on sometimes when you even run plan projections, but to have the flexibility and spend down from, especially if it's taxable assets first, then deferred, and then to those tax-free like Roth types accounts late. I mean, that is sort of the program that we teach in RICP and does tend to work in real life as well.
Sorry, I want to add one thought on that. That's one reason why the 4% rule in practice isn't that relevant, because you might have big lumpy withdrawals up front. Plan for it. A good planning tool will help you show that, and potentially may reduce withdrawals later. But just add that thought. Yeah, that's critical. That's so common, and making sure you plan for that's really important, especially the Social Security delay that you mentioned, Eric.
Yeah, I agree. Here, I'm going to start to put up a couple closing slides. We can keep taking questions, but go ahead, Steve, if there was another one.
Well, I'm just going to mention what I lost my point there, so go ahead.
Okay. Well, sure. Yeah, we only got a couple minutes, and we are going to actually stop on time at the 30-minute mark. A couple things just to mention is, so, I mean, the big thing, and then I want to make sure that I say, is to thank you to Rob and to Steve for sharing your time today. I mean, Rob, I feel lucky because I get to talk to you when I want, but it's so cool for you to be able to share your time and your knowledge with everybody. And Steve, same thing. I think I talk to you every day, but I just want to thank you guys for being here and having other people get to enjoy. And then the other final thing that I just want to show here that I know we're really excited about at the college is there's a conference that really is the first of its own. It's called Horizons. It's sponsored by the American College of Financial Services. Great location at a great time. It's going to be early March out in Coronado, California. And this is really focused just on retirement planning topics. We have not only experts from the college, but others in industry. And so if you can make it, we would love to see you there. And we'll look forward to that, sharing more information as we go. So we'll stop here on the half an hour. And again, thanks, Rob, thanks, Steve, and thank you to all of you who have been on the call today.
Expand your opportunities at theamericancollege.edu.